Welcome back to the Macro 12 Explainer, your professional weekly breakdown of the most crucial global economic trends. I'm thrilled to guide you through this one because right now we're watching a truly fascinating macroeconomic collision unfold. What we're seeing is the massive, basically insatiable capital needs of the AI infrastructure boom crashing directly into an increasingly fragile global bond market. It's a massive story about debt, technology, and global power, and it is literally rippling through every corner of the financial markets. Let's get right into it. The fundamental tension defining this week is how the AI economy's enormous need for financing is clashing head-on with the US Treasury's rising borrowing costs. We've got AI demand remaining exceptionally strong, sure, but financing the next stage of this massive build-out, that's getting a whole lot more expensive. And at the exact same time, investors are really starting to question whether hyperscalers and AI companies can actually generate sufficient returns on these enormous capital commitments.
Here is our roadmap for today's explainer. We'll be covering 1. Treasury intervention and yields, 2. The AI capital supercycle, 3. Geopolitics, energy and Europe, 4. Corporate resilience and crypto, 5. Cross-market synthesis, and finally, 6. Our final investment interpretation.
Starting with Section 1, Treasury intervention and yields, where we're looking at liquidity support versus structural deficits. Let's look at exactly what the US Treasury did this week to try and stabilize long-term borrowing costs.
Take a look at this crucial figure, 5.33%. That represents the roughly 19-year high recently hit by the 30-year Treasury yield. This sharp spike was enough to prompt Treasury Secretary Scott Bessent to announce an unscheduled expansion of the Treasury's buyback program. They are effectively doubling their liquidity support operations for older, less liquid securities to a minimum of $4 billion per operation.
And this brilliantly illustrates the current divide we're seeing in the markets. On one side, the Treasury's stated objective is simply to fix market plumbing and improve liquidity. But on the other side, investors remain highly skeptical. The initial rally faded fast, with the 30-year yield quickly pushing right back near 5.25%. Why? Well, because buybacks just don't solve the structural issues. We're still looking at a large U.S. fiscal deficit, rapid debt growth, and a rising term premium, which is that extra compensation investors are demanding for holding long-duration bonds amid all this uncertainty.
Moving to Section 2, the AI capital supercycle. We're watching a massive shift from a technology boom to a highly complex financing system. Let's see how this builds into the AI story.
Because the AI boom is no longer just about software adoption, right? It's evolved into a full-scale financing ecosystem. We're talking about a capital-intensive industrial credit cycle, everything from semiconductor design and massive data center construction to securing the actual electricity generation required to run these facilities. AI infrastructure is now being financed through incredibly complex private credit and project finance structures. The tech sector is competing heavily for capital across all these distinct industrial lanes. To really grasp the sheer scale of this supercycle, check out this figure. Broadcom is reportedly negotiating a debt financing package that exceeds $60 billion, and it could potentially reach up to $100 billion when subordinated debt is included. Just to put that into perspective, that's roughly the entire GDP of a country like Ecuador, all just to finance AI infrastructure for hyperscalers like Anthropic, which itself reportedly hit an astonishing $65 billion annualized revenue run rate. We are talking about unprecedented sums of private credit being mobilized to build out this physical infrastructure. Meanwhile, the companies supplying the critical hardware, they are generating massive free cash flow. Samsung plans to return up to $79.6 billion to shareholders, and SK Hynix announced a $29 billion buyback. This proves the incredible profitability and the strategic importance of high-bandwidth memory right now. For you as an investor, this creates a really stark distinction between companies that are merely exposed to AI hype and those pulling in massive, measurable cash flows from actual hard demand. Section 3, Geopolitics, Energy, and Europe, focusing on inflation risks and cyclical divergence. Let's step back and look at the broader global canvas here. Geopolitical risks are seriously threatening to inject inflation back into this already strained macroeconomic environment. Brent crude spiked above $93 a barrel this week. This is a direct market reaction to the U.S. preparing a coordinated economic isolation strategy against Iran and markets actively pricing in disruption risks around the Strait of Hormuz. This geopolitical risk premium is a massive deal for both bonds and equities. Higher oil prices can easily slow disinflation, push up transportation costs, and ultimately force central banks to delay those rate cuts we've been anticipating.
Over in Europe, we're seeing a really fascinating split in the data. Germany's manufacturing PMI rose to a 4-year high of 54.1, which shows a strong cyclical recovery driven by export orders and defense spending. But on the flip side, domestic services are contracting, pulling the composite PMI down to 51.0. This tells us that while German industry is catching a bid, the country still faces deep structural weaknesses like high energy costs and slow productivity growth. It's an improvement for sure, but definitely not a complete resolution. Section 4, Corporate Resilience and Crypto. Let's look at consumer adaptation and alternative assets to see how businesses are handling this pressure. Down at the corporate level, we are seeing some incredible resilience, but it's highly targeted. Consumers are aggressively adapting to inflation. Value players like Ross Stores and BJ's Wholesale reported fantastic trends, proving that inflation hasn't killed consumption, it's just shifted it over to discount channels. In Europe, we saw massive consolidation in Italian banking, with Monte dei Paschi launching a €34 billion bid to defend its competitive position. And in alternative assets, Bitcoin extended a major rally, supported by a weakening US dollar index and growing political interest, highlighting a continued global search for alternative stores of value. Section 5. Cross-market synthesis. Let's explore how the overarching price of capital connects absolutely everything we've just talked about. When you synthesize all this data, the true macroeconomic picture emerges. Higher term premiums in the bond market, enormous AI infrastructure spending, and geopolitical energy shocks are all pulling on the exact same threads: inflation and the cost of money. Whether it's treasury operations, AI chips, or retail earnings, everything comes back to making financing more expensive across the entire global economy. And this dynamic creates what we're calling our primary feedback loop. As the US Treasury struggles to contain long-term yields, the overall cost of borrowing soars. This puts immense, immediate pressure on AI companies. They're taking on billions in leveraged debt to build data centers, and higher yields meaning they now have to prove their revenue models can actually service that increasingly expensive debt much faster than anyone anticipated. But it feeds right back the other way too. The AI sector's insatiable need for capital means that major tech companies and private credit funds are directly competing with the US government for the exact same pool of investors' long-term money. You simply cannot analyze the bond market and the AI market independently anymore. They're completely locked in a tug-of-war for global liquidity. Finally, Section 6, Final Investment Interpretation. Let's talk about navigating this increasingly complex cycle. So what should you actually take away from this incredibly complex week? The narrative has fundamentally shifted. It's no longer just about buying leading AI software stocks. We're in a complex cycle involving debt, industrial policy, and energy. Here are your key defensible takeaways. Treasury buybacks won't fix structural deficits. The strongest AI plays right now might actually be the suppliers of scarce physical inputs. We're talking memory, power, and networking. And with energy prices threatening a new inflation shock, global diversification away from highly concentrated US tech assets is becoming absolutely essential. Which brings us to the most important question of the week. Can the AI capital supercycle generate enough real productivity and cash flow to justify its staggering financing needs before rising bond yields and energy inflation bring the whole party to a halt? The market is actively demanding evidence that this boom can earn acceptable returns in a world of expensive money. I want to know what you think about this. Drop your thoughts in the comments below, and let's continue the discussion on whether this supercycle can outrun the rising cost of capital. Thanks for joining me for this explainer, and stay focused out there.